All right, guys. So this episode, this stream, this recording is going to be about support and resistance. So I'm going to give you some textbook definitions on exactly what support and resistance is. And then we'll go into exactly seeing what it looks like on the chart. You already see some of the lines I have on my chart, but this is from Investopedia.com. It's a great resource for new traders, experienced traders, all traders of every kind. I mean, I've used Investopedia for a very long time. This is not sponsored, by the way. However, this is what they say about support and resistance. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying interest. As the price of assets or securities drops, demand for the shares increase, thus forming the support line. Meanwhile, resistance zones rise due to the selling interest when prices have increased. So what that means is a resistance line is a line of sellers that is not allowing the price to move higher. A support line is a line or area of buyers that is not allowing the price of a stock to move lower. Let's take a look at what that looks like. So this chart is of the Russell 2000. This is an index. So this index is 2,000 of the smaller cap companies on the US stock exchanges. So each of these lines is either a support or resistance. So when a price is underneath that line, it is considered resistance. When a price is above that line is considered support. These lines are pretty common throughout the stock market. We find them in everything. I mean, they pop up all the time in almost every stock. You can find support and resistance lines. The question is, are they valid? Let's take a look at some of these lines. So if we look at this price point of 215, as you can see, the tops of these candles, not the wicks, not these long skinny pieces, but the top wide parts of these candles all seem to line up on a specific price point. It does not have to be exact. Support and resistance are more of an area or a zone versus a specific price, because not everybody's going to be buying or selling at the same price point. There's a mix of those. And, you know, retail traders, professional traders, or, you know, hedge funds or market makers, you know, these are all different levels of traders with different levels of capital. So they're going to be able to make different price points of which they want to buy and sell securities. So with that being said, this level is pretty valid because it lines up with a lot of the candles. Now you can see as it was under here, it hits resistance, moves down, and then retests that resistance level before it breaks out. As that breakout occurs, buying kind of dies off and we trickle downward. We start trending little further. You can see where these candles have dipped down and touched 215. That resistance level is now support because it cannot pass that level. So it's holding up that price point. And as we kind of move closer to the price point, as we go further out in time, the stock and price try to attempt another breakdown. It tries to go beyond that support level. So with this, you can see that, okay, it broke through, it closed below that support. Now it gets bought back up. This huge candle, this skinny piece right here, is a lot of buyers just buying it up because they say, okay, well, we're at support. I'm going to put my buy order here. And if it hits it, great. We're going to get in at a decent price, as they say. And it's going to bounce. It's going to bounce off it like it bounces off of a wall. Like if you throw a tennis ball at a wall, it'll bounce. It's not every time. Sometimes you accidentally throw it over the wall and it kind of goes down. So it'll break through that floor. So that's the basics of support and resistance. It doesn't have to be a specific amount of times it attempts it, but you can see right here, this resistance area at 179, the price attempts to break out of it, and then it finally does. Boom. Right up through 180. So if we go out further, we can see that these lines match up. Let's say 158 right here. You can see where the tops of these price spikes touch that level. Let me remove some of these really quick. Now, you see this price level of 144, which is support for the IWM, and then 158, which is resistance for the IWM. With this, the difference between these two, this distance, is called a range. So, what some traders do as a strategy is they will buy at support and sell closer to resistance. I'm not talking about buying or selling the IWM or the SPY. I'm talking about individual stocks within that index, because that's what the index does. It maps out what those stocks are doing. So if I saw a stock that was about to break out, I would want to buy it when the indice is closer to support versus resistance. Although that's not always the case, that's just my strategy when I look for relative strength. Now, if we zoom in closer to where 158 played a major role of resistance, it broke out and continued higher before we had that huge drop off with the COVID-19 crisis. But as you can see, a lot of traders saw this 144, 145 area as a level of support. So with that, you can see that it's a valid level. That price point hits that 145, it bounces higher, and then moves lower until we get to the bottom of March. These levels have been contested, and a lot of traders don't look at them the same way technical analysis traders do. So you have fundamental traders, you have position traders that don't see these levels the way we do specifically. And that's okay. These look like they work. I know they work because I use them every day. It's just understanding what these levels do and how to play them properly. I like to use different aspects of stock trading and tools that are in my toolbox. So you can see all these lines moving across the chart, the very different colored lines, the big white line, the blue line, purple line, green line, or red line. These are moving averages. They are simple moving averages. They're not anything special or fancy. They're not an oscillator. They're just the average price on that time over an X amount of days. So 50 days, this is what the price averages out to be. 200 days. So these levels shouldn't be used as buy or sell signals, in my opinion. They are great for understanding price contraction and expansion. So as we see over here, these moving averages are very wide apart. This is what I call expansion. So these prices are already moving in a very rapid trend downwards. Now when it starts moving upward, it's still expanding because these are very, very far apart. But as the stock starts moving sideways, as the price starts getting tighter and tighter, closer to this 158 mark, you see these moving averages get closer and closer, and they get closer to that resistance level. As you can see, what that means to me is it's like a rubber band. The tighter and tighter you pull it, at one point it's going to pop. It's going to snap. It's going to go in a different direction. That direction could be up, could be down. I don't know. But I'm there to trade it. I'll have a stop loss in place and a directional bias. I'm usually long bias. I want the stock to go up most of the time. That's how I feel better trading. I'm not good at shorting stocks. So as these moving averages tell me, okay, the price here looks to be consolidating enough that it could be time for another expansion in price. So things are going to start moving again. And in fact, they did. They moved down to support. So all through here, these moving averages now are very close together. And as we get closer to the top of that range, they get tighter again, moving higher and higher, and then they break out. So a good example of this is a stock I took today, ABBV. So right here, these moving averages are all over the place, very far apart, very wide, scattered, not making much sense. But as we zoom in closer, I've found a level of resistance for when that price point breaks through that level of resistance, I'm going to buy the stock. What makes me more confident in that choice is these moving averages. They're getting tighter and tighter. They're moving closer together. So as they move closer together, it's like a rubber band, like I said. It'll usually pop off in one direction or the other. Now, it's not as simple as just, oh, moving averages, getting closer, here's the support and resistance, let's trade this. There's a lot more that goes into it, but this kind of gives you an entry-level understanding as to what support and resistance looks like on a chart and how moving averages come into play in that chart.